Unit 1, Topic 3, Index Funds. In this topic, we will be discussing what is an index fund, and we will be discussing the advantages and disadvantages of investing in an index fund. So just a little introduction to what an index fund is. An index fund is basically a list of companies designed to mirror and measure the performance of the market as a whole. So these funds are usually low risk and secure stable long-term profits. Some of the examples of these index funds are the Dow Jones Industrial Average, S&P 500, and the Nasdaq Composite. And an interesting fact is that usually on the news, when the newscaster talks about how Dow drops 100 points, it usually would mean that Dow Jones Industrial Average lost $100 in value. So some advantages and disadvantages of investing in an index fund. Advantages include they're ideal for passive investors as they don't really require an active person to be managing the fund for long-term investments. Unlike hedge funds and other funds, they don't require an active management fee. They are extremely great in diversification, as they usually have a list of companies that have low correlation to each other. And they usually secure strong long-term returns, at least in a bull market. And some disadvantages. They lack flexibility, or allow a portfolio to lack flexibility, as each share of a index fund usually costs a lot. For example, the Dow Jones Industrial Average, a list of 30 companies, are now worth around $20,000 a share. So if someone decides to invest in index funds, a lot of that portfolio's cash is likely to go towards the index fund. Also, price-weighted and market cap-weighted funds give unfair biases toward high-price stocks or high market cap companies. For example, the Dow Jones Industrial Average is a price-weighted fund. This means that in the fund, companies such as Amazon would have a greater influence than companies such as Boeing or Apple, as Amazon has a price of $2,000 per share compared to Apple and Boeing that only have a price of around $300 per share. And in a market cap weighted weighted fund, such as the S&P 500, it would give an unfair bias towards companies such as Microsoft that has an extremely high market cap compared to other smaller, less notable companies. So the performance of one company would have a greater impact on the fund than the performance of other in both price-weighted and market cap-weighted funds. On top of that, compared to active management funds, index funds are vulnerable to swings and market crashes. Of course, in a bull market, index funds would be prospering. But once a swing or market crash happens, then the portfolio value with someone that invests in index funds also crashes. As unlike an active management fund, people who invest in index funds are not able to predict or anticipate market crash or swings. On top of that, index funds only give a limited amount of gains compared to a lot of hedge funds or mutual funds. So, index funds are used to measure the market and mirror the market. So they're always performing as the market performs, unlike a hedge fund and a lot of mutual funds that claim to beat the market